Change brings uncertainty, but also enormous potential. The commercial real estate landscape in 2024 will be defined by innovation, adaptation, and new opportunities emerging because of this market shift. Today, we're going to explore the key trends that are poised to shape commercial real estate this next year and beyond, and more importantly, how you can capitalize on these trends. Remote work reshapes office demand. The rise of remote and hybrid work arrangements will have ongoing impacts on the office sector. Many companies are reducing their space needs as employees split time between home and the office. Outdated buildings are facing rising vacancies, providing opportunities for value-add investors to acquire these assets at discounted prices and reposition them to meet evolving tenant needs through renovations and redesign. This shift also gives the opportunity to redevelop outdated offices into more collaborative spaces with amenities catered towards these hybrid teams. There is strong demand for enhanced HVAC systems, outdoor workspaces, and more flexible floor plans. Investors may target newer buildings or life science properties better positioned for the future of work. VeriSpace in Dallas-Fort Worth is a prime example of this reuse because they took an old IBM headquarters and brought back an entirely new style of office space. Definitely check out that video here, and I'll leave a link in the description below. As downtown office occupancy declines, you'll have the chance to repurpose empty offices into multifamily housing, hotels, or some sort of other mixed-use project. The growth of experiential and entertainment concepts also allows downtowns to reinvent themselves for the more modern era. Logistics demand's still strong. Demand remains in full force for industrial facilities even as supply additions catch up with demand. E-commerce and inventory restocking continue to fuel warehouse needs, especially for last-mile delivery buildings near major metro areas where land is scarce, and much of this warehouse product has actually been torn down for a higher and better use. Investors can capitalize on this by targeting infill sites for redevelopment into modern logistics facilities or flex space, or just a covered land play for now. However, an economic slowdown could dampen expansions. Investors should target strategically located properties that can see demand from a wide variety of uses. Look for buildings near intermodal facilities like railroads and transportation infrastructure, such as highways. Markets are finally starting to balance after years of breakneck demand, which could mean that there are investment opportunities in secondary markets or even tertiary markets that were previously overlooked. Multifamily fundamentals remain healthy. Overall, positive demographics sustain apartment demand, although new supply is surging in many markets. In fact, RealPage data shows over 600,000 apartment units are set to deliver across the country in 2024. Investors should target properties in high-growth metros and employment hubs that are near public transit and walkable amenities. With so many units coming online, it could be a race to the bottom on pricing. So the better located your assets are, the better your potential to withstand any rent decreases. The challenge of obtaining financing is already slowing down new construction from moving forward. So in the next 24 to 36 months, we could even see a shortage of new units coming online. Unfortunately, more institutional investors are entering single-family rentals given home affordability challenges. Build-to-rent communities are proliferating to meet rental demand as development costs limit apartment feasibility, providing avenues to participate in this emerging product type. If you've been following me for a little while, you know how I feel about institutional investors getting involved in the build-to-rent market, and I don't think this investment strategy is a positive for the American dream of home ownership. Retail makes a remarkable comeback. Despite negative perceptions, the retail sector has shown impressive resilience. While e-commerce remains looming overhead, bankruptcies have slowed, and tenant demand is robust, especially for grocery-anchored shopping centers. This retail stability means investors should target well-located centers and enhance their value through redevelopments and tenant mix optimization. You should still exercise caution with enclosed malls, though, and urban retail that depends heavily on traffic from office workers. As underperforming assets become available at deep discounts, opportunities exist to dramatically reimagine and reposition properties through introductions of mixed use, multifamily, healthcare, and more experiential concepts. Retail property trades slowed dramatically amid interest rate spikes, but should pick back up as investors accept the new interest rate environment. Overall fundamentals point to a surprising retail rebound. Climate change multiplies physical risks. Extreme weather is increasing climate-related risks for properties in more vulnerable areas. Insurers are raising premiums and reducing coverage in higher risk locations. Investors and developers may need to factor adaptation costs into underwriting and project budgets. On the flip side, these challenges create opportunities for investors to acquire properties at risk of climate impact at more favorable pricing and implement mitigation strategies to reduce risk exposure. Investing in resiliency measures can substantially boost value and make properties viable for a longer investment horizon. ESG gains even more importance for commercial assets. Environmental, social, and governance factors are becoming a pivotal investment criteria. Investor mandates, government policies, and corporate commitments are driving demand for more sustainable buildings and transparency on these issues, like energy use and emissions. Existing buildings not meeting ESG standards present opportunities for value-add investors to upgrade systems and achieve green building certifications, allowing properties to qualify for certain loan products and meet tenant requirements. But market uncertainty lingers as rates remain high. The outlook remains murky as the Fed sustains an aggressive tightening stance. Lending conditions stay stringent and economic growth projections weaken. Real estate fundamentals are proving surprisingly resilient, but lingering uncertainties will lead investors and developers to remain selective and cautious. During periods of volatility and uncertainty, opportunities arise for experienced investors with a sound underwriting methodology. Taking a contrarian approach, like what Warren Buffett says to do, by targeting out-of-favor asset classes can yield strong returns. Providing flexible, tenant-friendly terms and focusing on cost control and operational efficiency becomes even more crucial. While risks and headwinds persist, opportunities abound across sectors and markets for savvy investors that are able to adapt to changing conditions. As the landscape evolves, staying informed and strategically positioned will allow investors to capitalize on these emerging trends. Check out this video here on the top commercial real estate markets in 2024.